In this video, I'm going to give you a market update. I'm also going to let you know how is inventory actually tallied. How much inventory do we have in any given month, and how is that broken down nationwide? Another interesting piece that I find very interesting is that if you look at the history of housing way back, I'm talking pretty far back, take a look at the history of housing. I'm going to touch base on both of those, and it's very interesting information, very interesting stuff. So when we're looking at the markets and we are looking at the big story of the markets, the big story of the markets is going to be national median home price declined 3.8% in the third quarter, and it landed only 4.7% below the all-time high reached in 2022, which was in June of 2022. It's reflecting typical seasonal trends. Prices didn't contract significantly in 2023 despite mortgage rates rising 0.6%. In October, the average 30-year mortgage rate reached its highest level since October 2020 at 7.79%. Higher and higher rates continue to price potential buyers out of the market and prevent sellers who are locked into hyper low rates from entering the market. And this is creating, the sellers don't want to get out of their rates, the buyers are having a hard time finding something to purchase, and on top of it, the buyers are also paying really high interest rates. So it is creating a bit of a pressure cooker from that perspective. Q3, real gross domestic product with GDP rose 4.9% quarter over quarter, indicating a broadly strong economy, although unemployment rose 0.3% to 3.9%. The jobs market remains robust. Inflation, which rose in quarter three, is nearly double the Fed's target rate of 2%. So rate reductions won't happen in the near future. They are starting to project rate reductions will happen. Not exactly quite sure when. It does seem within the first few months, possibly the second quarter of 2024. Now, if we look at the local lowdown or the local take, what's interesting is when you look at the local lowdown, a quick take on that is going to be the year-to-date single-family home prices are up across Silicon Valley. This year, condo prices during the pandemic actually did not do well. In fact, condo prices went down because people were having a hard time being next to each other so much. So people actually kind of went out and went to find their own space and bigger spaces as much as they could. So the condo prices did increase in San Mateo County and Santa Clara County, and prices did decrease in Santa Cruz County. And home prices, we do expect to stay fairly stable in the fourth quarter. In fact, they seem to continue to stay stable, and there continues to be a lot of competition for them as well. The year-to-date single-family home prices are up across Silicon Valley. Active listings declined slightly from September to October, breaking an 8-month upward trend. Year-over-year inventory is down 12%, highlighting the challenge of buying a home in a desirable market. And that's what I just talked about. Buyers are purchasing a property. It creates more of a competition. Inside the competition, whether the interest rates are skyrocketing or not, here in Silicon Valley, we tend to focus on the market, the overall stock market. The stock market really tends to dictate how property values are in Silicon Valley. Now, I wanted to also talk about an interesting piece, and if you look at this chart, I'm going to show you this chart in a second, but what's interesting is that people are talking about going into a recession in 2024. Yes, and that's absolutely possible. The analysts are not saying going to go into recession in 2024. It actually makes sense that we probably would go into recession in 2024 because of the way the economy has been as of late. So what people are talking about, however, is they talk about the housing market having an issue during the recession. I have a chart here, and it's the S&P Case-Shiller U.S. National House Price Index, and it shows that the housing stays strong through the recessions. And what this shows all the way back to 1960. We've had 9 recessions since 1960, and if you look, 2008, that's when we started to see an issue, and we started to see a decline in 2008. One thing that's very interesting there is that in 2008, the reason we had that decline is because the recession was caused by housing. There was lending practices that were very loose, and those guidelines for the lending practices being so loose really created a lot of people getting into the housing market and purchasing houses and continuing to pull money back out. And that created a big issue once all of those notes started to come due, and once we had any kind of an issue with people who couldn't no longer afford those loans. Once people cannot afford those loans, if they have 100% financing, they have no skin in the game. They've already pulled all the equity out of the home as well. Now people are putting more money down. The biggest difference, even if somebody puts down 5% or 3% on an FHA, even if somebody puts a low amount down, they're still in the position where they have to prove their income to the bank. So they have to prove that they have a job and that they've had the job for a certain amount of time and that it looks like it's going to continue. So that's the difference. And the lending practices now are much different than they were. core piece to what happened in the bubble of 2006-2007 in the Great Recession. And one of those things is going to be amount of supply. The supply that we had was enormous. And when you look at what creates that supply, it's going to be the formations and the completions. The completions are going to be what actually is the supply. The formations are going to be demand. There's a tremendous amount of difference in 2006 between the demand and supply. And when you look at what we actually have, the completions are going to be the amount of properties and the amount of building that was done, and the formations are going to be the way that the home was actually formed. Formation is going to be something along the lines of child who's living with his parents, he gets of age, he or she finds a new home. A married couple, divorce or split, and they end up in different homes. That's going to be formation. So when you look at that, in 2006, the formation was down and the completions were up. So there was tons of supply. But if you look now at this chart, in 2022 and 2023, the formations are actually almost level with the completion. So it's really creating the opposite dynamic of what we had back in 2006 and 2007. Now, with that, you look at the US births by year. And the reason this is important is that in 2006, people who were the age of 33 years old were born in 1973. 1973 didn't have a whole lot of people born at that time. So now you take a look and you look at what's going on today, is that you have the 33-year-olds that were born in 1990. Those are the millennials. The millennials, there are much more of them. Those people in that age bracket are coming of age to purchase a home. So folks who were born in 1973 were of age in 33, which is average first-time buyer in 2006, and the folks who were born in 1990 were of age to purchase on average in 2023. So that makes it much more people, a much higher formation, and we have much lower supply. And so that makes a tremendous difference. Now, if we go on to look at the existing home inventory on this next slide, in 2007, there was a tremendous amount of existing home inventory, and there was 4 million in existing home inventory, and in 2023, there's 1,080,000 of existing inventory. So it, again, creates a tremendous difference and much less supply. So all of these people, even though the interest rates are higher, people are still looking for a home to purchase.